Hi, it's James here again, and welcome back to the channel. If you recall, we did a video yesterday was actually on Saturday, about these trades that I'm going to show you in this video, and you can watch as we go along. I've been a trader for about 20 years. I've managed many millions of dollars of money in currency trading funds, and I've traded for a major international bank. And so I'm just sharing some of my expertise and experience with you guys, and I hope you enjoy it. So look forward to seeing you through the rest of this video. Well, we've got into these fantastic trades that the market gifted us yesterday. And if you have a look at the previous video on this YouTube channel, you'll see why we took these trades and what the signs were, and we're in them now. So the next question is, now that we're in the trades and we're profitable, what do we do next? So let's have a quick look at that, and this might just help you if you did take some of these trades and if you managed to get into this setup in the market. Just to recap, we saw these reversal candles against resistance levels on the euro, on the pound, on gold, and on NASDAQ. And we saw on NASDAQ the shaven head candle, followed by the star, followed by the hanging man. We saw hanging man on pound and euro, and we saw hanging man on gold. And we did spike up a wee bit above them, but that was a little fake out breakout, as they call it, and we've now firmly settled into the trades. And I'm going to tell you how to trade these. Now, most of these, I've either taken partial profits or I've taken all of the profits. Not all of them, but I've still got some of the trades open. But I've taken at least partial profits on some of them, and I'll explain to you why. Now, what we know is that the market doesn't go in a straight direction. So we're going to see some of these trades and markets move up and down before they continue in the direction that we want. Now, let's have a look at the euro, the gold against the US dollar. And there's that little trade that we took. There was the setup, which I put in the last video, the shaven head followed by the hanging man. And that was the setup against just above the 200 period moving average against resistance, just breaking above that previous support, and overbought stochastic and divergence on the stochastic. You can see the stochastic coming down, the market moving up. That's called divergence. That's the 1473 stochastic, which I pointed out to you. And now we've moved into this position, and you can see the market, after just creating a little fake out there, just a little spike up above that resistance level. That's quite normal. And that's just to really trap some of those bears into thinking, well, the market's actually going to go bullish, and we were wrong about it. But that's normal, particularly in such a perfect setup. Now that we're in this position, what do we do? I'll give you a rule of thumb. The market moves about, on average, about 1 to 2% per day. I'll give you two methods to calculate this. So if you look at the euro and the pound, for example, that's about 100 to 200 pips before we expect to get a retracement. So that's about 1 to 2%. Same thing on the Australian dollar, and you'd expect the same thing on gold. Now, if you look at gold in particular, often we get very big bullish candles on gold, but the bearish candles are not normally more than, well, this is about $30, this $30 to $40, the size of this candle. And you'll see often in the moves down on gold, we don't see candles much bigger than that before we get a bit of a retracement. Now, we've seen about $30 to $35 on this candle. Actually, I think it was $40. And we've now begun to move down towards this low. You can see there's a bit of support here as well, the previous low of that shaven head candle. So all of these things mean that the market's probably going to stall here. There is another way that you can actually calculate the distance that this is likely to travel on average before a little bounce and then a continuation of the move. And that's by using the ATR, the average true range. It's an indicator that you can put on the bottom of your chart. I'm going to try and show it to you right now. So we've got a sort of a squiggly line at the bottom here, and if you see, it moves up and down according to the market volatility, but you can see it generally moves from around $35 down to about $25. So that's about there. So that's more or less an average over this period, and I've set it at 20. You could set it at 50. If we change it to 50, it'll just smooth out a little bit. We can do that right now. So if we change that to 50, you'll see that it just becomes a bit flatter. Probably gives you a better indication. But overall, you can see the average there, and you could even put an average line on there I think you're able to do that with some of these tools. It's around about $25 to $30. And if I go back even further in time, you can see if I just draw a line kind of in the middle, it's around about $27.50 per day that this gold instrument, metal, is likely to move against the dollar. So we know that once we get to about $25, $30, $35, this one's moved $40 already. So we've gone beyond the ATR, beyond the average true range, which means it's overextended. It's really as simple as that. We've also got down pretty close to the 20-day moving average. So all of these things have led me to exit this trade and look for an opportunity on a bounce. I'm not going to trade this long because the direction that we're trading is short. Scalpers might like to get out of the shorts and try a long at this sort of level, but I'm not interested. You can see if we go across back here that it is actually quite a good support level. You might be able to get down to that 20-day moving average before a bounce, but we're not going to trade this long. We're going to wait for a bounce off there, off this sort of area that we're in right now at $1,770. We've reached the beyond the average true range. We're overextended. We've got near the 20-day moving average, and it's a good time to get out. And it's a very simple process of getting back in. We want this to bounce up about 38% at least, and so we can just draw. I'm not going to go into the hour chart, but if we draw a Fibonacci from the top to the bottom, we can find out what area we want to get back into this trade to carry on the move short. And there's my little fib. And you can see the 38% fib is where this green line ends. And there I've got a price at 1,784. 1,784. Just so happens that's a very key level on the overall long-term chart as well. So that would be my plan. Wait for a bounce to 1784, get back in short, and we'll be aiming down, further down to go to the next level, which would be somewhere down some of these support levels here. So that's how to get out of a trade and how to get back into it, because we don't want to be left behind. Take care. Have a great trading day.